what I've been seeing on those cost segregation reports is they're getting approximately $100,000 of depreciation on the money that you put in. A syndicator needs to be extra conservative. If the property significantly underperforms, there's no success fee to be paid.
You miss 100% of the shots you don't take. Make those shots calculated.
We set them up with an 8% preferred return, meaning that the minimum an investor is going to earn will be 8%.
It sounds like, once you've found that person, you want to make sure that deal works for you. How long is my money going to stay with you? And what are my returns? What am I going to get out of this?
The biggest mistake an investor make is strictly relying on the financials of an offering memorandum. What you're buying at that point is not historical performance. What you're buying is a promise.
If you're waiting for the right moment and the perfect moment, it does not exist. Wayne Gretzky says you miss 100% of the shots you don't take. If you're not taking any shot in investing in real estate today, then... This is the Cash Poor Asset Rich podcast. I'm Mickael.
I'm Amer.
We break down real estate in a way that's simple to understand,
easy to relate to,
and practical enough to act on.
Let's get started.
Before we go into this episode, I know we talked about the difference between a little bit of what a REIT does, but I was looking into it a little bit more. And so kind of going through the Fantastic Four. So the first one, the tax side, the depreciation, and you being able to save on the tax side that we've discussed in previous episodes. I'm gonna read exactly what it says. It says for our REIT, it says you get paid, you pay taxes. No real tax benefit on that side. So bad for taxes. Syndication, you get paid, you often show a loss on paper. Depreciation wipes out taxes. Kind of going into the active or passive side. We don't have to get into all of that, but I'm just kind of comparing the two. So that's very good for taxes.
And Mickael, it makes sense because like when you're investing in a REIT, you don't have deed to the property versus you do have deed to the property with a syndication. As a result of the deed, you get a negative K1 in the form of a depreciation on year one you buy it. And obviously if you do a straight line 39-year depreciation, it's much slower. But if you do the cost segregation and accelerated bonus depreciation year one, you're going to get a very, very big negative K1. What I've been seeing really in the marketplace is I've been seeing a depreciation benefit of dollar for dollar. So for somebody that puts $100,000 in today's world, and what I've been seeing on those cost segregation reports is they're getting approximately $100,000 of depreciation. So you're getting dollar for dollar depreciation on the money that you put in.
That's incredible. That is incredible. And what we'll bring in a tax expert that will go dive into all of this in the near future in the episodes that we'll be bringing in. But so move on to the second side, which is the appreciation. So it goes up with the stock market because a REIT at the end of the day is considered stock. So it just goes up with the stock market. You don't control anything in terms of that. So average upside. Syndication side, value is forced. So kind of going by if you make a decision on who your sponsor is or who you're syndicating with and who you're giving your money into, whether it's yourself or, and this kind of compares whether it's a syndication or you investing yourself versus a REIT. On the syndication side, value is forced, like I said, rent increases, expenses going down, improvements, etc. So bigger jumps in value, better upside. Number 3, equity. You own shares just like a stock on the REIT side. No real equity pay down. So you feel it's almost like weaker wealth building, if you will, versus syndication. Syndication, the tenants or the person renting your space pays down the loan. Your ownership grows over time. So stronger wealth building. And then the last one is the cash flow. So REIT, obviously steady cash flow. The cash flow is there, smaller payments, consistent but lower versus syndication. On a REIT, you can expect a potential 3 to maybe 6% return, and syndication usually higher cash flow plus a bigger payout when sold. So bottom line, the only downside to syndication, which I don't even call it a real downside, but is having your money potentially locked in for a little longer period of time versus a REIT you can buy in, buy out anytime you want, whether it's at a loss or at a profit. So REIT equates to convenience versus syndication is wealth building. So I just wanted to kind of paint that picture
I'd like
before.
to add a little bit to this as well.
Sure.
So in a syndication,
Hmm.
investors are paid what we call a preferred return. The way
Preferred
we set
return.
up
Okay.
our syndications is we set them up with an 8% preferred return, meaning that the minimum an investor is going to earn will be 8%. Now, that
Hmm.
depending on the business plan, if this is a value add business plan where value is created down the road, then the preferred return is accrued and it's paid out at the sale of the property. So, no immediate cash flow in a value add strategy. However, that money is accrued, and once the property sells or refinances, if, for example, somebody puts in 100,000 and they have an 8%
Hmm.
preferred return, and property did not pay out any returns because it's a value add, we're waiting on creating value in order for us to pay out the returns, then the return will accrue at an $8,000 a year for that investor that put in the 8,000. So if the business plan is a 3-year business plan, then they just accrued 8,000 times 3, that's 24,000 over the 3-year business plan. And then if there was a sale that takes place in 3 years of ownership, then they will also reap the benefit of the upside of the profit of the sale, in addition to their preferred return. So the way the waterfall would work is preferred return gets paid out, return on equity gets paid out, and then profits gets paid out after that. So the investor will reap the benefit of all the accrued returns for putting their money in addition to the return on equity, the original 100,000 that they put in. On top of that, they will receive their pro rata share of the profit of the value creation of that asset. So
Okay.
typically, in a stabilized asset, the property will pay out a preferred return immediately post ownership, and that is paid out on a quarterly basis. The return in that scenario is not accrued because there's enough cash flow since it's stabilized to pay out the investors,
Mhm.
and then we just pay it out quarterly. Now,
Got it.
the preferred return, again, is the minimum return the investment is going to accrue or pay out. However, if the underwriting realizes a 9% return, for example, or a 10% return, then the investor will reap the benefit of the promised 8% plus their pro rata share of anything above and beyond the 8%, depending on how the syndication is set up. Typically,
Got
the
it.
way I set up our syndications is I set it up on a two-third, one-third split of anything above and beyond an 8%. So if the property is generating a 10% return on equity, then the investor will receive their first 8%, and then there's 2% remaining. They would receive two-thirds of that 2%. So they will receive an aggregate total of about 9.2%, and 0.8% goes towards the sponsor for managing the asset as their success fee.
Okay.
They're
Got it.
stabilized and there's value add. But in either scenarios, if the return is not paid out on a quarterly basis, it is accrued to be paid out at the time of sale or refinance. So the money is
Okay.
not gone, the money is just accruing for a big payout at the end of the business strategy or the business plan.
Okay. So pretty much, I know we'll have a full episode breaking down how the syndication works, but pretty much you give your 100,000, you're almost guaranteed a preferred return on that investment, whether it's immediate or when I say immediate, paid out quarterly, or it's accrued over time once the asset has stabilized, meaning it starts generating income based on the business plan that you into place. Um, and yeah, and then the difference between if anything is if that asset is generating over the 8% preferred, then the sponsor is paid their portion, and then the investor gets the bigger piece, I guess.
Yeah, they get the leverage.
Again, yeah. So we'll dive into that. I just wanted to kind of break it down, but based on what we discussed on our last episode, which was making a decision on, in this case, investing with someone, whether it's a family friend or a syndicator, we realize, they have a good financial backing. That's one. Number two is experience. They've done, whether it's 1, 2, 5, 10, whatever it is, they have some type of experience to show that they've earned their stripes to be able to, like, okay, I can invest. Kind of like when we read reviews online. Okay, does this business have experience serving other customers, and those customers are happy? And then the third is, do they have some type of skin in the game in terms of them investing their hard-earned dollars into this deal that you're going to invest in?
And
So
Michael,
let's say yeah, go ahead.
skin in the game does not have to be in the form of money. A skin in the game can be
Sure.
in the form of putting up some personal guarantees to secure the debt on the property.
Absolutely.
Because a personal guarantee of $1 million is $1 million that's on the line. It's as good as $1 million
100%.
in cash. Also, they could leverage their balance sheet. So by leveraging their balance sheet, they are showing that they are a bona fide sponsor. They have the financial backing, and they are successful at running real estate transactions in the past. As a result of that, their company has been in business for X amount of years. They have multiple full deal cycles under their belt. So their balance sheet, leveraging their balance sheet in order to secure debt or in order to secure the deal altogether, is
Yeah.
a form of skin in the game.
And correct me if I'm wrong, but like, even if somebody wanted to choose option one, meaning investing themselves and actually running, they even have to have experience. They can't even go to the bank unless they're funding it 100%. The bank is not going to be like, "Oh yeah, we're going to give you a loan on this. You have zero experience." So, as an investor, option 1 technically isn't really a thing until I have some sort of experience, whether it's investing with, you know, another person or even a joint venture. The banks won't even, I mean, look at you at the end of the day. That's
It's
right.
on investment real estate, it's very, very hard. Some of our listeners
Mm.
can be doctors and or attorneys, and they've went and bought their owner-occupied building and thinking that this qualified under the investment real estate umbrella. It really doesn't, okay? And the reason for that is, it is considered an owner-occupied property because their business or their medical practice is in that building. That form
Mm.
of financing is very easy to receive. Almost any bank that you contact, whether it is, the big threes, Bank of America, Chase, or Bank of America, Chase, or Wells Fargo, any of those guys love that type of product because they know that the operator has skin in the game. It is their medical office or it is their attorney's office, and they know that those type of professions are more than capable of being able to cover the mortgage. In addition, obviously, they would ask for personal guarantees from the owner, but that is not investment real estate. That is not
Okay.
out and getting a loan for an investment real estate. Those acquisitions are very, very easy to get. The programs are out there. Dentists, for example, they have programs out there where they receive 90 to 100% financing on a real estate purchase, as long as their business is occupying the building that they're looking to buy. But
Oh wow.
when your building is occupied by third party, they're occupied by
Mm.
tenants. It's a completely different ballgame. We're talking about investment real estate, and then when you look at the big three, Chase, Wells Fargo, or let's call it Fifth Third or Comerica, which is one bank right now. those guys have some very, very strict requirements on investment real estate funding. And it gets very complicated. Not only that, they look at the cash flow of the asset, not only that, they look at the asset value itself, but they also want to make sure that in the event this asset goes dark and there's not a single tenant in it, the underwriting is not based on the cash flow of the asset. It's based on the cash flow of the actual borrower. Can the borrower
Got it.
still sustain that mortgage payment if that building goes 100% dark? And that's unlikely in investment real estate loans. When you look at some of the other products out there, whether it's a life insurance loan or whether it is a CMBS loan that's more designed for investment real estate, it is a different requirement. It's a different underwriting. Therefore, the groups that we're discussing on this episode, the doctors and the lawyers may have had a tremendous amount of success getting financing on their owner occupied property. They may experience that. That's not the case when they're looking at investment real estate.
That makes total sense. Okay. So, I mean, yeah, at the end of the day, like you said, it's not considered a real estate investment if it's because it's almost considered as a business now, like as lending as a business, your operator at the end of the day. And the investments that we're talking about, it's more kind of like passive. You're investing and just reaping the benefits of the Fantastic Four without actually being the landlord, without actually being involved in the day to day. And which is kind of going back, the first decision you have to make is, am I investing with the right person? So let's say we have, you know, let's unpack the first layer. First layer, like we talked about, are those three items, which is, finding a sponsor or family friend or whoever it is that you're investing with, covers the financial side, meaning they have a good financial backing. Two, have the experience. And then three, has skin in the game, whether that's money or signing on the personal guarantee side. You found that person. You've done your homework, and now you're like, okay, I have evaluated that person to invest with. Now, layer number two, what questions, because I'm sure it goes beyond that. Just because somebody has financial backing, just because somebody has experience, and just because somebody is writing their name doesn't have to have a successful track record at the end of the day. What are the next, what's the first question you ask before investing with that person that you just found?
If you ask me, that question
Mhm.
would be, have they gone through a full deal cycle? Have they completed a full deal cycle from A to Z? They've acquired, they managed, they've exited, and upon the exit, they made their investors money. That
Okay.
would be my very, very first question. Or it could be somebody who's new to syndications, right? But has a track
Okay.
record of individually investing in the past,
Hmm.
understands commercial real estate very well, has held commercial real estate positions in the past, and were able to exit successfully. That would still qualify because at some point, there's a lot of new syndicators that come to the market as syndicators, but however, were individual investors before that. And I qualify in that category. I started my syndication firm back in 2022. But prior to starting my syndication in a firm in 2022, I've been investing in real estate since 2012. So I already had a 10-year track record.
Sure.
I was not raising
Okay.
capital. I was not putting together sophisticated investment plans. However, I was buying and selling real estate, and I understand the fundamentals and what it takes to enter and to exit. But I also was a beneficiary of the 2008 crisis and the 2020 COVID-19 pricing and the appreciation that we've seen after those two. So when I mentioned that on a previous episode, I didn't mention that out of thin air. I was a direct beneficiary of those two cycles.
Got it. Okay. So now we're finding the person that hits all those three, even the experience that you just mentioned, make sure they've done a full cycle deal. Is that it? Does that stop there? Once I have found this person that covers all these three items, is there a second layer in terms of are there more questions to ask, or do I just hey, you need 100,000? I'm going to wire you 100,000 right now.
Well, I would say the fourth layer that that's important to recognize is
Hmm.
we're in the people's business. At the end of the day, we're trading real estate, we're managing real estate, but we're in the people's business. If I
Yeah,
don't find synergy with the person that I'm working with,
sure.
then I'm just not gonna feel warm and fuzzy about working with that person. Because you hit it at the beginning of this episode. Real estate syndication or individual real estate investing is not liquid. Unlike investing into a REIT, you can't liquidate. You can't wake up tomorrow and say, you know what, I want to change
Hmm.
positions and I want to
Yeah.
liquidate my position. In a syndication or individual investment, the only way to liquidate your position is to sell. Well, the asset that's in question may not be ready for a sale. It may not have matured. It may not have created value. It is still in the immature phase of its business plan, and as a result, you're just not ready to dispose and sell that asset. The asset has not hit its climax. You've let's call it its peak performance to be able to unload it. What are you going to do? You're going to pick up the phone and call the sponsor and say, "Hey, I want to force a sale." No, there is an exit. And I've exercised that in the past with syndications that I've done. The exit would be is to go out to the network and see if somebody wants to pick up that membership interest. That
Hmm.
that person that's or that entity that can pick up the membership interest of the investor that's looking to exit can be done either by talking to the other investors in the syndication, see if they want to pick up more share of the investment. That's an option. The
Okay.
second option, it would be to go out to the investor network and just speak to them and let them know that there is a position that's available on this asset. One of the investors is looking to get out, and then there'll be a membership interest transfer between the entities or those individuals. But it's slower. It's not like just clicking a button and say, "Hey, I want to liquidate
Right.
my stock position."
And it's not just slower, it's not ideal. If you're investing, just invest and ride the wave, regardless what it is.
Yeah,
Mm.
yeah. Any real estate syndication that you want a part of, you want to have a realistic expectation. 3 years
Okay.
minimum based on that business plan, and understanding that business plan before you invest is very important. Make sure it's aligned
Sure.
with your investment strategies and investment goals. But I would say 3 year minimum. 5 years is average. And there are assets that we hold for 10 years. December 2025, we bought a shopping center that's fully stabilized. And that shopping center is a 10-year business plan. The investors that participated in that deal are fully aware that this is a 10-year business plan and it's a 10-year hold.
Okay. It's kind of like going into a CD, like if you're putting your money in,
Spot on.
it has to stay there for a while because you're agreeing to this upfront. And for the people that are listening, it sounds like, once you've found that person, you want to make sure that deal works for you in terms of, how long is my money going to stay with you and what are my returns? What am I going to get out of this at the end of whether it's a 3 year, 10 year, 5 year, whatever it is that you're agreeing to? Anything can happen. Nothing is guaranteed. Once again, nothing that you are going to get into and put your hard earned dollars into is guaranteed in terms of how the business plan looks because anything can change. And we all know that very well. I mean, look at 2008, look at 2020. Or the Great Depression, like you mentioned previous episode. But you can only control so much. The rest is up to God at the end of the day. So now, are there any red flags that I should like? Again, we have found this person. They check all the boxes in terms of credibility. Are there any red flags that I should like? Okay, I need to walk away from this like immediately, even though the guy checks all, or the person checks all the boxes.
Michael, I don't. If you've done this, if you're that far into due diligence, I
Hmm.
don't think that there's anything that you got to worry about in terms of red flags. I was listening to Jeff Bezos once, and he said the reason why small business turns into giants, specifically in the United States, and we've seen that with companies like Google, Meta, etc., and his obviously Amazon. The
Hmm.
reason why these companies turn from small businesses into giants is because the US has more seed capital to fuel businesses than any other country on the planet. That is the
Wow.
only reason why we get so big and our companies turn into conglomerates. Of course, there's a very, very successful business plan, there's a breakthrough product, but
Hmm.
what's fueling that growth is the amount of seed capital available out there. And think about it from that perspective is when you are investing into startups, what do you really know about these startups? We're putting 100 grand back in 2005 when you put 100 grand into Amazon. Okay. What did you know about Amazon beside that they were selling books? You didn't have access to Jeff Bezos directly. You didn't
Yeah.
have you didn't have the intel that you would have in a typical syndication where you're actually buying a real asset. You're buying a brick and mortar building that's occupied with tenants that's generating cash. You're buying a promise when you bought Amazon back in 2005. And there's tons of seed capital that was put into the company because of the perception where that company goes and because of FOMO, fear of missing out.
Yeah.
So if you know, we've mentioned one, two, three checklist items that we need to check to ensure that the sponsor that we are trusting with our hard-earned money qualifies and is a bona fide sponsor to be able to run a real estate transaction. By comparison to some of the seed capital that the same investors have invested in company in startups that they just didn't know whether they're going to make it or not. I mean, I put in some money in a startup last year. I put in $50,000 in the startup last year, and I did it strictly based on hype and based on a
Hmm.
relationship that this company is going to be sold. Well, and look at fast forward to 2026, doesn't it's not looking like it's going to be sold. So I bought a promise. And
Yeah.
how much due diligence did I do in the company? Very, very little. I didn't do a lot of due diligence. Yeah, yeah, it's not a huge amount, but at the same time, there was not a lot of due diligence that was done. So what I'm trying to get to over here, if you've done one, two, three, and four, and you've gone through all of this due diligence, at this point, there's really no red flags to worry about because you've done investments in the past that were far more emotional
Risky, probably.
and risky
Yeah.
than you would do
Hmm.
buying a real asset that's made out of brick and mortar.
Okay. Like as far as the risk goes, since we just kind of touched based on that a little bit, what what could I know a lot of things can go wrong, but what have you seen gone wrong in terms of the risk side?
And I think this is what we should really focus on is what I'm about to share here. The representation of most commercial real estate assets are done through a third party broker. Okay.
Okay.
Very few deals happen off market. Very few deals happen without having a professional representation, especially if it's a larger asset. And the larger assets are typically brought to market through a document called the offering memorandum. The
Okay.
offering memorandum is a summary, a marketing summary of what is being offered for sale. What you would see in an offer memorandum is you would see the company that's the third party broker representation that's representing the asset. You would see some highlights in the first few pages about the asset itself. You would see some highlights about the market. highlights about the population and the nearby businesses, nearby employers. And then the offering memorandum really dives into projections. And many offering memorandums are written based on a pro forma rather than actual performance. In my opinion, and what I've seen in reviewing offering memorandums, that should be the biggest red flag when you look at an offering memorandum from a third party broker. What you're buying at that point is not historical performance, is not in place performance. What you're buying is a promise that in the event the asset performs as such numbers, these are the returns that the new owner should expect. And typically, those projections or those performances are done on a 10-year period. So they can show what a 10-year investment strategy would look like for this particular asset.
But that's not a good thing or a bad thing, right? Like, uh, if it is, if a offer memorandum, which is in other words, what, like almost like a sales sheet
Yeah, it's a
to sell
marketing
you.
a marketing package.
Okay, so a marketing package about a particular asset, and is a promise good or bad? I mean, obviously, if it's a property that you're buying that's a value add, some kind of promise has to go in there. Or am I wrong?
Depending on if the promise is realistic or not. So
Got it. Okay.
what I would say to that is I would say the biggest mistake an
Mhm.
investor can make is strictly relying on the financials of an offering memorandum to base their underwriting based on somebody else's perception of how this property is performing. Because
So they're selling you the dream, and at the end of the day, is the dream realistic or is it far fetched?
that's exactly right. That's exactly right. So what I do is when I do my underwriting, I don't really take the projections or the pro forma that's in the offer memorandum. Unless it's the offer memorandum states that it's in place. In place financials are what they are, and you can audit what's in the offering memorandum when you get further down the deal. But for the sake of doing your underwriting and making a decision whether this is an opportunity you want to pursue or not, okay? You would just take what's written in the offer memorandum as an in place. Now, if their offering memorandum states that it's a pro forma, then I immediately ask for historicals. I would like to know if I'm buying an asset in 2026, I would like to know how this property performed in 2025. And is the in place based on 2025? Is it based on the last 12 months? I want to know those details when I am underwriting a deal on the financial side.
That makes total sense. And it is.
The nice thing about having an experienced sponsor is you don't
Mhm.
have to go down this rabbit hole. You're relying on the sponsor's experience to be able to vet these variables, these mistakes that an investor can potentially make, especially if it's their first, second, third deal.
Okay. But isn't but a syndicator or a sponsor will also offer you an offer memorandum.
That's correct.
And speaking of offer memorandums, again, kind of going back at the end of the day, whether it's a sponsor or not, but when a broker does it, it's more it's almost one-sided. It could be true, it could be, but it's the dream is inflated a little bit. Let's call it that way because they want to sell, they make money on just getting that prop asset sold versus a syndicator will stay with you. They're part of the your team throughout the whole journey of that asset.
They're aligned with you. When you
Yes.
talked about their alignment comes in the form of having skin in the game. And
Yeah.
they're aligned. A syndicator is paid a success fee based on the performance of the trend of the asset. If the asset doesn't perform, syndicator does not
Right.
get paid. So inflating or creating an offering memorandum that's not realistic,
Right. Doesn't
it
make sense.
doesn't make any sense whatsoever.
Yeah. Yeah, absolutely.
On the contrary, a syndicator needs to be extra conservative when they're writing the offering memorandum because they want to make sure that they meet preferred return that they state they're going to meet, and they want to make sure that they're eventually going to get a success fee from this transaction because this is how they get paid. If the property significantly underperforms, then there's no success fee to be paid, and the sponsor hasn't been compensated for their hard work because they did not underwrite the deal properly.
And you have to have some level of discipline to say yes and no to deals, because if you're just having that FOMO or that hype that we've talked about of like, oh my gosh, I this sounds good, I'm just gonna go with it. Regardless, I think whether it's, and I agree, this indicator definitely has a lot more of your interest because their skin is in the game. They're part of the deal. They're aligned. They're part of that whole journey with you. But it's still for you as the listener, understanding an offer memorandum, I think, is another layer of importance too, because that all the terms will be on there as well, right? Is like the return, how long it will take, or is that not on the offer memorandum?
Generally speaking, you would see a 10-year projection. So
Okay.
okay, this is the 10-year projection. This is the net operating income over the 10 years. But very, very little you're going to see an offering memorandum layered with debt from the broker. You're not going to see that.
Yeah.
But you're going to see that
Yeah.
in an offering memorandum from a sponsor because the broker's offering memorandum will show net operating income year over year for the asset based on the tenant lineup that's in the asset. However, they're not gonna layer debt because everybody's debt requirements and equity requirements are going to be different.
Yeah. Totally.
And
Okay.
the returns on from when you're part of a syndication, your returns as an investor are received after debt is satisfied. Debt is serviced from the actual income of the property. You're receiving an income based on the net cash flow, and that's typically underwritten very well in an offering memorandum that's put together by a sponsor because they know what they're making debt assumptions based on what they think the best debt would be for this property. So it would be net operating income minus the mortgage is the net cash flow, and then distributions to the investors is based on the net cash flow. And the mortgage
Okay.
component is very different depending on who the sponsor is, how much equity is being brought into the deal, how much money is being borrowed. And this is why brokers don't really put that in their offering memorandum because everybody's different. What if it's a cash buyer? They're not
Yeah.
they're not doing any debt, you know?
Okay.
What if it's a buyer that's borrowing 75% of the purchase price? Another borrower can be borrowing 70% of the purchase price or 65% of the purchase price. So it'll be very hard to really underwrite debt in a broker offering memorandum. The broker offering memorandum is going to, as mentioned, is going to have those fundamentals about the market, a 10-year projection, the rent roll, who are the tenants, what type of escalations they have, when their leases expire, maybe some tax and parcel information can also be listed in the offering memorandum. Very high level information with assumptions on what the 10-year net operating income would look like for that particular asset.
Okay. And for you guys listening, I've actually, been on the sidelines looking at deals, Amer and I, and it goes deep. I mean, it really goes. It's like you can get lost in translation pretty quickly because it's more than just the overall. Like as an investor, if you're just investing, it's not as easy as, or even going to the stock market. Oh, okay, I did some homework. I understand the stock might do well in the future. I'm just gonna put $100,000 and hope for the best, and see you in 5-10 years. This is this is more, it goes a lot deeper in terms of the underwriting, in terms of how the structure is set up, whether it's a fixed asset class or a value add. But like, there's a lot of work that is involved, that if you decide to do it on your own, I think a lot of people will be capable of doing it. It's just setting expectations and understanding, that you're okay with making a lot of mistakes. You're okay with going into something that is unknown and kind of getting, like we talked about earlier, getting funding for something like this. It is a lot of work versus just sitting back and here's my 100,000. I did my homework on picking the right sponsor. If you did your homework right, you should be able to trust that person. I do this similar thing for my businesses, and if I've done a good job interviewing for the position that I'm bringing in for somebody to operate my business, I'm hoping I've done a good job bringing them in to be able to run that company. It's a very similar concept here. If you're betting on somebody that you've done your homework on, you should just, it's not a Hail Mary. It's more, okay, I've done the best I could in terms of picking the right sponsor. If you're waiting for the right moment and the perfect moment, it does not exist. You got to just, the Wayne Gretzky says you miss 100% of the shots you don't take. If you're not taking any shots in investing in real estate today, then you're missing out. But make those shots calculated at the very least. And that's what we've kind of talked about. And that's what this whole podcast is about. It's educating you enough to be dangerous. You don't have to know the ins and outs of the whole investing cycle and how it works. But if you become somewhat of an intelligent investor early on, you're minimizing your risk. I'm not going to say there isn't going to be a risk. There is always risk in anything you do, but you're minimizing it as much as possible and putting that through and just, you don't need to be a genius. You just have to be disciplined enough to be able to make the kind of the right choice when picking to invest with somebody.
Mickael, it goes down to picking your team. If you pick your team
Sure.
right, you're going to be in a good shape. And that team can consist of layers of multiple industries. I think that any successful investor out there should have a great CPA, should have a great corporate attorney, should have a great financial advisor, a great life insurance rep, a great real estate syndicator, and the list goes on and on. Maybe a great nanny. Your success is only as good as the people you surround yourself with. Surround
Absolutely.
yourself with professionals that are good in their fields and understand their field very well. They're going to elevate you. So
Mhm.
pick your team right, pick your people right, and the sky is the limit at that point.
Absolutely. Absolutely. Well, we've talked about the mistakes that could potentially happen. We've talked about, what a smart investor looks at. And now the real question is, how do you actually take all of this and start your first investment? And that is what we're going to get into on our next episode. Thank you so much for listening. If you got value from this, do something with it.
Subscribe,
Ask better questions,
and stay consistent.
because building assets isn't about one big decision.
It's about disciplined and calculated ones over time.
If you know someone who earns well but isn't building assets the right way,
Share this with them.
this is the Cash Poor Asset Rich podcast. I'm Mickael.
This is Amer. See you next time.